Everyone says covered call ETFs don't beat the market. You collect large monthly distributions, and in exchange, you sacrifice growth. And historically, that's been correct. But GPIX just did something that income investors aren't supposed to see. Over the last trailing 1 year period, GPIX didn't merely keep pace with the S&P 500, it actually outperformed. And while the margin may be tiny, I think it's worth talking about. And I want to compare it to everybody's fan favorite, QQQI, and even some older funds, Jepi and Jepq, to see just how much of an anomaly this is. And even at the end, I'll compare it to some leveraged ETFs to see how it's comparing to those as well. So as always, hit that subscribe button, and this is definitely not financial advice. This is just one guy on the internet giving you his own opinions. So hopping over to Seeking Alpha, on the 1 year chart, we can see that GPIX has returned 17.91%, while the S&P 500 delivered 17.88%. And that's just a very, very, very marginal beat. SPYI from NEOS, 16.25%, and Jepi all the way down at 7.62%. Very disappointing for Jepi. I wondered, if the S&P 500 funds are doing this well, how are the NASDAQ funds doing? And GPIX, just like its counterpart GPIX, is actually right on pace with the Qs, returning 21.6% over the past year. QQQI, around 5% less at 16.16%, while Jepq's actually done pretty good at returning 17.94%. And next, I want to back out and go back to the inception date of GPIX. We can see that since inception on October 23rd, 2023, it's returned 75%, while the S&P 500's at 82.28%. SPYI is back there quite a ways at 58.32%, and Jepi's all the way down at 34.62%. So we can see that since inception, GPIX has outperformed SPYI and Jepi by a healthy margin, but it's still not keeping up with the index. So when we look at the NASDAQ funds, instead of using the inception date of GPIX, I'm actually going to use QQQI because its inception date was actually after GPIX. So from January 29th, 2024, we see that the Qs returned 61.96%, whereas GPIX was right behind it at 57.89%. QQQI was down a little at 51%, and Jepq was in last at 45.55%. So we see in both scenarios, the Goldman Sachs funds are actually tracking closer to the index. And while GPIX may be outperforming on the 1 year chart, when we zoom out a little bit, we see that there's still a slight lag in these funds. So just some quick comparisons between the Goldman Sachs funds and the NEOS funds. SPYI has a distribution rate of right at about 12%, whereas QQQI is at 14%. Since inception, I've found that these have kind of stayed very consistent, whereas the Goldman Sachs funds have also been fairly consistent, with the GPIX S&P 500 fund usually hovering around 8%, while its big brother, the NASDAQ GPIX, usually hovers right in the upper nines, sometimes a little bit above 10%. So if you had QQQI at 14% distribution rate, if you put $100,000 into this fund, that would be $14,000 in income in a year, with the equivalent GPIX, if it were hypothetically at 10%, if you put $100,000 in, that would be $10,000 per year. And while both of these are giving out massive return of capital yields, this reiterates that the Goldman Sachs funds do keep a lot of that value inside the net asset value or NAV of the fund, which appreciates with the price return. And I have a video specifically on GPIX that kind of shows the compounding power of the increasing NAV as well as an increasing distribution, because the price return on the Goldman Sachs funds has been so significant compared to the NEOS funds, which are still distributing about the same income as inception. I worry about that long term in terms of my value keeping up with inflation. I want my distributions to outpace inflation. I've noticed a lot of people in the comments tend to reinvest some of the NEOS income back into the fund to kind of counteract this. And lastly, I'm going to add in XQQI, the leveraged fund from NEOS, just to see if it's doing any better than QQQI. Its inception date was February 2nd of this year, and since inception, we can see that GPIX is outperforming it. And over that zoomed in time horizon, It's actually lagging the Qs. And looking at the S&P chart, when we add an SPI from NEOS, their leveraged S&P 500 fund, we see that it actually keeps up a little bit better than their NASDAQ fund at 6.3% compared to GPIX's 6.91 and the S&P 500's 6.85. I know that the leveraged funds are newer and time will still tell how they do in the long run. But for me, right now, I don't think there's any reason for me personally to take any extra risk, at least with the NEOS leveraged funds at this moment when Jepq and GPIX have been doing so great. I'm curious to see if this will change over time. And looking at the 19A1 filings of both the NEOS funds and the Goldman Sachs funds, they seem to be still over 90+% return of capital. As always, that could certainly change with your 1099 at the end of the year when they do their final accounting. But so far so good on the return of capital front, if that is a deciding factor for you and your income decision. With the Goldman Sachs funds, you're giving up a little bit of income now for a little more price appreciation and a total return that's more on par with the index. Whereas with the NEOS funds, you're giving up a little bit of price appreciation while keeping a decent total return and more income up front in the form of return of capital. I've noticed a lot of commenters in my previous video mention that they like holding both the NEOS funds and the Goldman Sachs funds because they pay on different weeks and they like getting that twice monthly paycheck from each of them. So I'm curious to see how both of these companies continue to perform moving forward with these covered call funds. I know it seems like every week I look and there's a new fund. I use the old Jepi and Jepq, but the newer funds from JP Morgan, ROCQ, and ROCY do seem to be doing much better, much more in line with the Goldman Sachs funds than even the NEOS funds, though those funds are kind of too new to tell. So after they've been out for a year or two, I'd love to come back and revisit this. One of my favorite pastimes is kind of comparing funds and seeing how they've been doing in different market environments. The past couple of months, we've kind of been flat on the S&P and NASDAQ after that significant rally we had earlier in the year. So hopefully we're going into a meta of the stock market where these covered call funds can continue to outperform, and maybe the NEOS funds will be able to catch back up in that environment. I'm excited to see what happens next. Let me know if you own any of these funds, if you swapped any of them out for any of the other newer funds, and I'll see you guys in the next one.